I do, of course, always like to cover what I saw happening in the stock market this week, kind of a summary of everything. And let's start off with the signals, actually. So right now, our stock market signals for both fast and slow are red. Have been that way for a little while now.
Hmm.
And You can see why the market's been coming down. We've had, kind of a big down week here. Now, our bond signals, interestingly enough, we have a green on our fast signal and red on the slow. And what's happening in the bond market, it seems to be kind of hitting some support levels, bouncing around. We've been going from green to red, back
Hmm.
and forth. That's very typical for a bottoming, motion that it kind of flashes a bit. So anyway, at the moment, we're, invested back into the bond market on our IRA type of accounts and still sitting in T-bills, at the moment on our non-IRA accounts. So this chart that I'm showing you here goes back, kind of shows the 2008 downturn and where we're at right now. And I'm trying to pull things back in terms of time, at least somewhat so, because one of the things that really helps, I think, when the markets start to get volatile or down like they
Hmm.
are, is kind of look at the big picture. Where are we all together and how is this all playing out? Because there's a tendency for all of us to attach different news things. So, for example, right now, the earnings, in my opinion, have been pretty good. I mean, Amazon reported after hours yesterday, 13% increase in revenues with $143 billion of revenues for the quarter. I mean, that's a big jump for a
Hmm.
big company. We had a almost 4.9%, gross domestic product reported for the quarter, which is outstanding, actually. And retail sales, consumers are spending money is essentially what's happening. You
Yep.
can see it with Amazon, and Microsoft had great numbers. Meta had great numbers, and in some cases, I thought Google had pretty good numbers, but then they had, a couple of areas like cloud computing and AI where they underperformed. And then, of course, guidance, what they say they see coming in the future quarters tends to be kind of a rough one sometimes. So good news in this environment can kind of be bad news.
Hmm.
Yeah. So when you get a 4.9% gross domestic product, that's actually really good news. I mean, that kind of pushes out a recession even farther off,
Yeah.
in my opinion. It might even take out some of the worst case scenario recessions that could happen with that much growth and what have you. But nonetheless, when you take a look at that number, you'd think, oh, things are great. But the market looks at that and actually came down that day because there's some concerns that the economy's too hot.
Hmm.
The Fed Reserve is still going to have to raise rates, and all of these pieces that happen. And the problem is that the Fed has overraised rates historically several times and caused some really big downturns. In their defense, it's very, very difficult to do what they're trying to do. They look at data that's coming in now. Okay, we just had this 4.9% gross domestic product growth, and we have to decide what to do, move rates up, and that effect won't happen for 3 to 18 months. And so that's where it gets really hard to comprehend. So they raise rates, and then all of a sudden they find out that they did too much a
Yeah,
year from
they're
now.
taking educated guesses.
Yes. And they often have overdone it one way or another. They'll leave rates down too long, which is a criticism for this particular spike in inflation, or they'll raise rates too much, which happened, in hindsight in 2008 and 2000. So, you know, these are the things that are kind of driving the market right now. The situation in Israel, I think, is really bothering the market. You can see the motion. And when you sit in front of the computers like we do, and watch the market kind of minute by minute, and you see different news pieces, you can tell where the market has concerns.
Hmm.
Not so concerned with what's happening one way or another in the House with the speaker and such. And as Americans, we are probably, because there's legislation that needs to be done and things. We got to keep the government open, by November 17th. But those don't seem to move the market much. But when you see stuff coming across the screen about what's happening in Israel, some developments there, the market moves. When you see the GDP come and anything that the Federal Reserve might be thinking about or talking about, the
Yep.
market moves. Anything the Federal Reserve says. So you can kind of focus on those important areas as far as that goes. But I drew two lines, a little bit hard to see because I've got such a long-term chart here, but we're in our support zone now between 4,050 and 4,200. And so this is where we're going to kind of see if we can hold. All right. We have, had this great run up since last October. and now we're back into the support zone. So I think this is kind of a normal thing. I think I'm not too concerned at this point in time. Doesn't mean the market won't go down, but it does mean that you have to kind of, Charles Dow, who did the Dow Jones Industrial Index average, he created that. He also created the Wall Street Journal, what have you. And he had a saying basically that the primary trend is still in place until proven otherwise. And so we'll talk about, what that means to prove it. But I do want to do one thing I think is kind of fascinating here. And maybe we can clear off that weekly summary thing there too, just real quick. There we go. So this is going from the very bottom of 2009. So the 2008 downturn. The March 9th, 2009 was the bottom of that big downturn, 57% from high to low. And the red line in the middle there is what's called a regression line. So it's essentially taking all of the data points and finding a line that fits the best amongst those data points, right? The blue bar on top is the upward channel, and the kind of pink or red bar on the bottom is the down channel. And so those are two standard deviations above or below the red line, what we call the baseline, the regression line. And if we look at that, first of all, that line is going right through all of these data points, is kind of the best fit, and we are almost right at it right now. We're just barely below it.
Yep.
And so what that means to me when we look at this is the market is where it should be, right? It shouldn't have been below like it was in 2020. That was an extreme downturn, rightfully so, big pandemic. It shouldn't have been above, right? I mean, we're talking 2 standard deviations. That's above 2 standard deviations. That's way out there. So it's too hot, too far, too fast. That red line sort of has like a pull. Things are going to come back to that red line. And that's where we are. And I think this is one of the things, we get locked. Oh, we're having this situation with Israel. We're having a speaker scenario. We've got a government might shut down. We have inflation. But we're right where we should be, right? On the long-term trend, looking back at this particular, uptrend that started in 2008, we're right where we should be. Now, maybe that changes or something, but that massive trend is still in place, and we're right there where we should be. And I think that's important to just kind of remember some of the long-term aspects. All right, and so looking at what Charles Dow would look at in terms of what the primary trend is, what they look at is, are the highs higher or lower than each other? So last year, all the highs were lower, one after another, like 4 in a row. And so that's a primary downtrend, okay? Are the lows higher, right? That would be a primary uptrend. And so I circled the lows, 1, 2, 3, 4, where we are now. Yeah, we're still in a primary uptrend, okay? Now I'll add some other pieces. This is, moving averages didn't exist in the 1880s. That was more of a 1950s, 60s is where you really read about it a lot. The blue line there is the 200-day moving average. So one of the things that I look at is what direction is that 200-day moving average going, right? Just for trend direction. So when it's going up, I'll consider that one of the check marks to say, hey, this is a major trend is up. The primary trend is up. So it's still going up. The other thing I look at is that 50-day moving average. Is it above the 200-day moving average? I'm not so concerned whether it's going up or down, just above or below. And so when it goes above, it's called the golden cross, which we saw back in February of this year. Not bad, all right? When it goes below, that's called the death cross, which is what it did last year, I think about late March. And so something to pay attention to. Now we're still above, right? So again, that's another piece that means primary trend is up. So we don't have any proof yet that the primary trend has changed. And so you want to invest as if, and continue to hold in there as if this is going to continue to go. And that's kind of the simple part of this, in terms of how you might want to look at this. Now, if you look at the bond market, much different scenario.
Yeah.
200-day moving average is going down, right? The highs are lower as we go. The 50-day moving average is below the 200-day moving average, right? So the bond market, we have a different system of kind of dealing with that because that's in a primary down direction, right? We might move back in, but we'll move back out pretty quickly. We're trying to find a bottom. We'll see what happens. Maybe we get it. If we don't, we get back out and wait for the next bottom. And we kind of come in and out much more so when we're in a primary down market. And when we're in a primary up market, we want to kind of stay in there Because one thing that will happen when things do recover, if they bounces out of what we're dealing with now, we could get a very strong bounce.
Yep.
And so if you're out, you could miss 5% very quickly. I'm not sure this is going to happen. And one thing I want to make very clear, I'm not saying that I think the stock market is going to go up from here. I don't make those predictions because I find that predictions are a really poor way to invest. Mm-hmm. What I do is I look at it and I want the market to kind of prove things to me before I react to that. And so right now, I think anybody in their right mind would have some concerns. We're 10% down off of the high that we set back in July, but that concern shouldn't raise to the level of panic. Mm-hmm. And so it sort of is for the market. We're getting this big stretch to the downside. We're stretching right into the support zone. We've got a very heavy bearish sentiment. People are, answering these surveys.
The fear and greed index is at extreme fear.
Yep. And that's when you want things to be purchased, not sold, on average. Last week we talked about the B of A index, which goes from 0 to 10, and when it's below 2, which it was 1.9. The average rate of return is 5.4% over the next 3 months. And so, here we are. We've got this extreme stretch, extreme fear, and so these are times to really be maybe more opportunistic with what you're looking at, especially when the 50-day moving average is above the 200-day moving average. When that changes, then you change that thought process, okay? Mm-hmm. But until that happens, that's important. And so we need to see some, resolution, settlement in Israel, I believe, right? Mm-hmm. To see a market that's really going to move here. Because I think that particular powder keg that's there is just enough with all the other things going on to say, okay, I don't want to take a lot of extra risk right now, okay? And so it's kind of adding to that pressure. We need to see something happen there on a positive basis. I don't know where that's going to end up or how long that's going to take, but that's one piece. The other thing is we need to see inflation continuing to come down. Right, that's the other big. It's the Fed and Israel. Those are the two biggies, in my opinion, right now. And so today we got the report from the favored measure of inflation for the Federal Reserve, PCE, Personal Consumption Expenditure Index. So this is a basket of goods that the Fed favors. This is a core PCE, so it doesn't include food and energy. And again, this is what the Fed looks at when they're talking about getting to 2%, they're talking about this. Yep. This was just reported today. It's at 3.7, okay? But the trend is important to me. And so this is versus last year, 3.7% higher. So prices are still going up, but they're not going up. It was at 7.7%. Yep. So it's going up at a slower pace. And the trend is down. Now, it's not down as much as I'd like to see it. I wish it was falling faster.
Yeah, but to be falling fast with inflation is a recession.
That's exactly right. It would take something really falling apart in a softer landing zone like we're in now so far. You would end up with more of a gliding down of inflation, and it would take longer, where we might not get to 2% for a year, right?
Yeah.
From where we are at this pace. Now, so that's pretty good. We did see one thing that bothered the market a little bit today in that same report. You can look at inflation versus last year. So if we look at, okay, September of this year versus September of last year, that's what we just looked at, 3.7%. We can also look at September versus August of this year, and then August versus July, you can go back. And so you can see it was 0.3%. If you take 0.3% times 12, that's 3.6. That's still higher than the 2% target. Mm-hmm. And so it's a pretty big jump for 1 month. Now I show you the last 3 years. There's a lot of really big jumps in there you can see. Yeah. But what I'm looking at here is the last 4 months. Got a 0.2, a 0.2, a 0.1, and a 0.3, right? Mm-hmm. If you take those, add them up, and multiply them times 3, because 4 months get to 12 months, that's 2.4%. So right now, if we keep doing what we just did the last 4 months for the next 8 months, we're at the target for what the Federal Reserve wants. Kind of fits into that 12-month timeline where inflation might get back down with the soft landing scenario. So it's kind of amazing to me. I mean, this whole thing that's happening right now with the market coming down, the negativity, you can see it. I mean, you get you get some really good earnings reports. You get maybe a decent move on that one stock, but no carry through to the rest of the market. When things are positive, you often get carry through to the rest of the market.
Hmm.
When things are negative, you know, you'll hear more about like Ford struggling, because their strike or what have you. The negative stuff negative's always there, positive's always there. Market's going down, everybody's emphasizing the negative. When market's going up, they're emphasizing positive, even though that news is still there if you just hunt for it. And so right now the market is in a very negative place. I don't think that's a terrible thing. Again, we're in the support zone. Fall at the bottom of that support zone, that's a different story, right? So I'll be watching that. And it makes me nervous in the sense that, you can be standing on the edge of the cliff and be completely safe, but you're not as safe as you were when you were 10 or 15 feet back from the edge of the cliff, right? So as we get closer to the bottom of that support zone, I get more nervous, just like anybody else, because it could mean a directional change. We'll have to do something about that. I hope it isn't, because I'd like to see this market continuing to go. I think there's a lot of good things out there that are happening, because ultimately a big gross domestic product growth like 4.9% is bad in an inflationary environment, but it's still not bad, right? It just isn't. We're having too much growth. Well, okay, it's not great, but it's not a bad thing like having a negative growth, which is where the recessions come in and what causes the really big downturns. So anyway, that's what's happening for the week. In my opinion, kind of the summary: focus on Israel, focus on stuff that the Federal Reserve would look at, PCE, the GDP reports, the job reports, those types of things are what the Fed will be talking about. The Fed meets next week, Tuesday, Wednesday, right? And will come out. Right now, the futures market is betting a 99.4% probability that there'll be no rate increase in November. And that seems to be what we're hearing from the Fed in their interviews also, that they're looking at a pause. But we'll see what happens. The next meeting, of course, will be December, as far as that goes. So anyway, that's what's going on this week. Thank you for watching the summary. Look forward to being able to kind of summarize this again